So the flight to yield seems to be on in Europe. What will happen to treasuries?
Well, looking at a two-year Treasury note, it's trading in the 130s. The repo rate, which is the cost of money, the federal funds rate, is trading close to 160. In other words, there's negative carry. Those that purchase the two-year note at 135 or so and borrow money at near 160 lose money. Investors only engage in that type of investment, of course, if they believe the cost of money will fall, or they simply are worried and are not worried about the negative carry. So yields are probably as low as they can go absent a rate cut. But they could stay here for some time because of the fear that exists in markets. But do beware the other side of the V. Markets are talking about the very negative side and impact of the coronavirus on economies and such. But there is likely, and we all hope from the human side of the perspective, something else on the other side of this. And so most likely yields snap back at some point, but not high enough along.
Do you think investors are keeping like risk premia to one side and also economic fundamentals because they want yield? And what does that mean for Europe?
Well, for Europe, as I mentioned to Tom, the economic growth is so slow that it's teetering on the edge of stall speed. And so markets are worried that the coronavirus issue, given the economic impact in China, could hit Europe and tip Europe into recession. We already see in Japan very bad numbers lately on GDP. But again, one has to question as an investor, is the demand that's being destroyed simply delayed, or is it permanent destruction? In in most cases, the economic activity is likely to be delayed and there will be a snapback. So for Europe, the problems that are hitting nations there, because they have a big relationship with China, you could say much larger than the United States, the impact probably will dissipate over time, and investors should look through it to some extent.